Hey everyone, welcome back to the channel. It's Monday, April 20th, 2026. There's a really useful tension developing right now between some of the more bullish voices on Wall Street and what our own Elliott Wave system is showing. Tom Lee has been saying in recent interviews that the next correction might not be as deep as many people initially expected. His reasoning is straightforward. A lot of the market has already gone through its own bear market. Stocks like Microsoft and other big names corrected hard earlier, so a good portion of the excess has already been cleared out. Because of that, he thinks we might only see something closer to a 10% pullback rather than a deeper 20% type of move. On the other side, our Elliott Wave analysis has a different take. We now view the recent 9% correction as wave 4 of the larger impulse. That means the current rally through $701.66 is the final portion of Wave 5. The recalculated targets for this Wave 5 show the base equal leg level has already been reached or slightly exceeded in the 710 to 725 zone, with an extended target sitting higher at 730 to 760. Because this is an extended Wave 5, our projection for the following ABC correction is deeper than average. Using standard Fibonacci guidelines on the entire impulse leg from the April 2025 low, the expected retracement is 38.2% to 61.8%. That translates to a projected major bottom in the $610 to $650 area, which works out to roughly a 12 to 18% correction from the eventual Wave 5 high. The deeper end of that range looks more probable after an extended fifth wave. So how do these two views fit together? They are not necessarily mutually exclusive. There is meaningful overlap. Tom Lee is focused on the idea that the market has already done a lot of the heavy lifting through rolling bear markets in individual sectors. Our Elliott Wave count is looking at the structure of this specific impulse and saying that because Wave 5 has extended, the correction that follows tends to be larger than average. In practice, this means we could still see a meaningful decline, potentially in the 12 to 20% range from the eventual Wave 5 high, even if it doesn't turn into a full-blown bear market. How are we handling this in the project right now? We are taking some profit on any positions that are in the green during this bounce, spreading those profit-taking levels across the full target range from roughly 710 to 760. At the same time, we are holding the bulk of our long-term positions. If this Wave 5 keeps running and we push into the upper part of the 730 to 760 zone, excellent. We take profits at strength and let the remaining winners run. If Wave 5 completes and the larger correction begins, we stay patient and will look to buy on clear system signals during the decline. The key is having a plan ready no matter which way the market ultimately decides to go. This updated Elliott Wave picture fits into the broader 2026 project outlook we've been building. Q2 is still the highest caution zone, especially with rising inflation forecasts continuing into Q4 and the new Fed chair transition still pending. Our time and timing system continues to highlight June through August as the highest probability window for the sharpest decline, with a plus or minus 1 to plus or minus 2 month tolerance that could push it into September or early October. Q3 could see stagflation-like pressures peak. Q4 remains the best window for potential recovery once the mid-year risks are digested. Our base case of a roughly 20% correction sometime after the new Fed chair arrives, but before Q4 is still on the table, but the exact depth and timing now feel more flexible depending on how extended this Wave 5 ultimately becomes. The real edge in the project has always been staying balanced. We don't need to pick one camp and ignore the other. We can acknowledge the bullish near-term setup from the Wave 5 structure and Tom Lee's view while still preparing for the possibility of a deeper corrective move later in the year. What do you think about this updated Elliott Wave shift? Do you see room for the rally to keep going toward the 730 to 760 zone? Or are you more focused on the potential correction that could follow? Drop your thoughts in the comments. If this fresh look at the divergence between Tom Lee's view and our Elliott Wave count was helpful, hit like, subscribe, and turn on notifications so you don't miss the next one. Thanks for watching. Stay patient, stay prepared, and I'll see you in the next video.